Hello, hello, everyone. Welcome to another Friday Live here from Arizona. Welcome, everyone. We are going to get into some stuff because some things happened this week and we want to talk about them. So I'm getting the question constantly, what is happening with the mortgage rates? Are we headed to a recession? And what is going on with housing? So we're going to talk about all of that. And joining me is somebody that I've had on the channel before, and he's coming back because he's a good one to talk to about this stuff because he knows some things. So welcome, Matt. He is in a hotel room, so I'm just gonna tell you, like,
Yes, yes. Happy Friday, Shawn. How are you?
happy Friday, happy Friday. Yeah. So lots going on.
There is a
Lots
lot
going
going
on.
on.
Yeah. The Fed met this week.
Yes, and they decided, of course, to just no surprise.
Right. I was just gonna say, no, I don't think anyone's
Status
surprised by
quo,
that.
no big changes.
No.
No, the big thing everyone was looking for was, okay, the Fed met and they have something called a dot plot map where they project, hey, what do we think unemployment's going to be this year? What do we think the GDP is going to be this year? What do we think inflation is going to be this year? And they look at all those measurables and they will tweak those numbers.
Mhm.
The only number that actually, in terms of the economy, that worsened was their anticipated inflation numbers. But they do think unemployment is going to be slightly higher, and they do think, and that's the big thing we're looking at right now, is the GDP. Is they believe that the GDP will come in a little bit lighter, which is when you're talking about recessions, that is the biggest. Unemployment's a factor, but the biggest measurement is the gross domestic product.
Right. Well, and I mean, I think that right now, honestly, at least this is what my feeling is. I feel like the unemployment, we've been kind of bouncing around, not even bouncing, we've been pretty flat, right? At 4%. And the most recent number came out at 4.1. And I think some people were kind of like, oh my gosh, we've gone up. I mean, 4.1, it's not that much. But I think that people are now looking at, like, with all of these terminations with government jobs, like,
Yeah.
how is that going to affect unemployment, really?
Right. And remember, these are all lagging indicators. So
Right.
it takes time. Right.
Right.
So there will be a point where all of these layoffs will catch up with the number where it won't be a surprise to go to 4.2, 4.3. And I think the Fed is anticipating that. But we were at historical lows. So it's not like even a 4.5% number is a terrible number.
Right. Because I mean, think about it. Back in 2008, what was our unemployment rate back then?
Oh my gosh.
I know, I can't remember right
I was
now.
thinking it would have to have been like at least like 8 or 9.
That's what I was thinking. I was thinking around 8.
It's like 8 or at least. And then some of these jobs reports also don't factor in people that have just given up,
Right.
and they're not even seeking employment.
Right.
Right. So yeah, and then you have people that are working part-time that we consider employed, but they want to work full-time. So they're really struggling because they can't find the gainful employment they need.
Well, it's funny. I heard something a while ago, and I'm just remembering it now. Some of these people that are that people want to look at as quote unquote unemployed, they're not unemployed because we have new ways of people making money.
True. And yeah, that's a
world,
great point.
this whole influencer world, like, these people might be looked at technically as quote unquote unemployed, but they're making money.
Are making money. And it's just some of it's the craziest ways.
Right.
So like I'm in Las Vegas right now, and there's a guy that we follow on TikTok, and all he does is play high stake slots. And I saw like a quick clip with him, and he's like, yes, gambling, I lost like $200,000 last year, but I made money because of TikTok and all
Because of his,
social media. He
his
still came up.
monetization.
It's his job. It's a profitable job.
Right.
Losing money.
That's crazy.
So there's no way to track it. I mean, you're right. It's not like it's not a standard W-2 job.
No.
And these influencers, there's all, multiple platforms that they can make a living on now.
Right.
Or, like Spotify, musicians, like all these different platforms where people can make money. It's probably outdated, quite frankly.
The way that they track
some of the metrics that we use. Sure.
Yeah, I would agree with you. I mean, because I just think about it, and There's people out there, and they do it on multiple different, ways that they're making money. And it's not, they don't have, or they don't need like a quote unquote, like normal job that most people are used to having.
That's very true.
Yeah. So, well, I want to jump into this article here that is in Housing Wire, which I thought was a great one, talking about the Federal Reserve. Because, as you said, no one's surprised that they kind of held firm with the rate cuts. So this one says, there was no surprise on Wednesday as the Federal Open Market Committee, or the FOMC, chose to leave the federal funds rate unchanged at a rate of 4.25 to 4.5%. The decision was almost universally expected as market observers, as the Federal Reserve weighs data that could be pushing the U.S. towards a recession. We're going to get into that. The short-term direction of mortgage rates, which are closely tied to the Treasury yields, then benchmark interest rates, remains uncertain. Rates have consistently decreased over the past 2 months, coinciding with President Donald Trump's return to the White House. But economists and policymakers are closely watching inflation data and unemployment reports while analyzing Trump's numerous tariffs to see where the U.S. economy is headed. Recent indicators suggest that economic activity has continued to expand at a solid pace, the FOMC said in a statement announcing its decision. The unemployment rate has stabilized at a low level in recent months, and labor market conditions remain solid. Inflation remains somewhat elevated. On Tuesday, UCLA forecasters issued a recession watch due to several factors. They noted the workforce reductions tied to increased deportations will result in labor shortages for sectors such as agriculture and construction. This analysis also determined that tariffs will raise prices for a variety of goods and manufacturing inputs, and it noted the downstream effect of layoffs and restructuring efforts in the federal government. During its customary post-announcement press conference, Fed Chair Jerome Powell acknowledged the potential for a recession, but he cautioned that this exists at all times and believes the odds are still at relatively moderate levels. There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, he said, it has moved up, but not that high. So I just want to jump back into that really quick, because this is kind of what we were just talking about with the jobs and all of that. But I also wanted to bring up something else, because I think it's interesting to see. This is showing you the dark blue line is a recession indicator. Mm-hmm. And the dotted line is interest rates or discount rates for the United States. And so this is something that I've talked about this before. And Matt, you're a good one to talk to about this, because people often get really nervous about a recession. And I mean, rightfully so, right?
Sure.
Because it just means things are more expensive, and jobs we're losing jobs, and all of that, which none of those are good things. But when we start talking about mortgage rates as it pertains to recession, you have to really look at this, because whenever we go to hit, these gray areas are the recessions, right? And this is all the way back to the 1970s. So there's 1980, 81. As soon as we hit that recession, look at the dotted line, how fast it falls.
It does. When it happens in a hurry.
Yeah. I mean, look at that. Look at how fast that falls. And that was in 2022. 2002. I don't remember, honestly, and I was selling real estate then. I don't remember a recession in 2002.
I don't either. But where you're on right now, this is where it's interesting, because you can see how quickly it happened there. Mm-hmm. And I believe that would be 2008 is maybe like 2008 is when this started. What is that?
Well, right here, this is at 2007, December 2007. Okay. Down here is 2008.
So we have to think about 7. So right before that recession occurred, even in like December of the prior year, all these analysts like Goldman Sachs were saying the probability of a recession were super low.
Right.
And then it was going to be a banner year for the markets. And it just happened again very, very quickly. And mortgage professionals have a very twisted reality, because what's terrible for everybody else is usually positive for mortgage originations. Like things like Ebola, COVID,
Right.
all these terrible events, they bode well for mortgage rates. And a recession has always resulted, going back to these charts, back to the 70s, anytime we have had a recession, mortgage rates have always trended lower. But yeah, I mean, when we hit the pandemic, obviously it spiked in a hurry. I mean,
that's what this is right here. I mean,
straight up, which is obviously crazy, right? But I think we also be very careful, because everyone was trying to talk about recessions last year, and there's something called the SOM rule. Professor,
that's what this is.
Claudia SOM, right? Is that what this is? Oh, it is. Sorry. Yeah. So the SOM rule. So what she was saying, which she was warning last year, was, look, just because we have all these recessionary indicators with inflation, you keep in mind is that unemployment is still very low. We haven't seen unemployment spike high enough where she thought we were really facing a recession. And remember, although it's not called that, a recession is supposed to be 2 consecutive quarters of negative gross domestic product, which we're not even projecting anywhere remotely a negative number right now. We're still very much in the positive.
Right. So Omega Royale says that's a clue. And I'm sorry, you were probably talking about something that we spoke about earlier, and so I'm not sure what you're referencing. So let me know about that. So I just think that things like this are great to look at as far as real actual data, because we can talk about all these things kind of conceptually, right? But until we look at data, especially over the long term, it kind of gives you more peace. Again, you hear it, you can get really emotional about all this stuff, but when you look at the data, it kind of brings you back down to, okay, this is the reality, right?
For sure.
Yeah.
For sure. Everyone wants to talk in extremes.
Yeah.
And remember, Fed policy has always worked in extremes. Either they're, slamming on the brakes, or they're hitting the gas.
Right.
And the other day when they met, they're also talking about, do they unwind existing securities, or are we quantitative tightening, or are we quantitative easing? And I think at some point they will have to start a quantitative easing process, which if they do that, that would bode well for mortgage bonds as well.
Well, and I think what's interesting too, when you start talking about the interest rates overall, it is everybody wants to correlate the Fed funds rate directly with mortgage interest rates, and they do not directly correlate.
No,
right?
They don't.
Yeah, but yet over the last few months, our interest rates have come down a little bit, right? But
they have.
Really
have. At least we're not in the 7s, right? We're in the 6s now.
Yeah. I mean, and that's directly related to the 10-year treasury, which has come down.
Right. What you see really is a reaction, because if the Fed is reacting in a manner where they believe we have all these recessionary factors and they're really concerned about the economy, at that point, they are going to make a cut. And as a result of that, again, no direct correlation. As a result of that, you might see, the Treasury react in a favorable manner for mortgage rates as well as mortgage bonds. So, for example, today I just looked at it. The 10-year Treasury ended at 4.257, which all in all, we've kind of been wavering along a line for the last couple of weeks. So obviously, and I think Logan makes mention of that as well. So the 10-year Treasury is something definitely we need to watch. If it was to fall below 4%, we could see a run on, bonds, meaning rates would be lower.
Right.
And, the other thing is the spread between the 10-year Treasury and actual mortgage rates, post-pandemic was at this monster level. And we're seeing that gradually start to shrink. So
Mm-hmm.
even with a little bit of improvement for mortgage bonds, but some gradual improvement with 10-year, that should really give us a little bit of a kick as far as lower mortgage rates as well.
Right. All right. I'm gonna pull this back out. So I'm gonna get back to this article. So peering into the crystal ball, in their summary of the economic projections, Fed officials lowered their expectation for gross domestic product, the GDP growth. They anticipate the GDP growth of 1.7 in 2025, down from an estimated 2.1 in December. They also upwardly revised their expectations for unemployment and their preferred measure of inflation, the core PCE index. The jobless rate is now expected to average 4.4 this year, with core PCE, including volatile food and energy prices, averaging 2.8. So this kind of goes on. It's quite detailed about what they were talking about there. But so let's look at the Fed and the White House. Mortgage rates have leveled off this week, although the average 30-year conforming loan is priced about 30 basis points lower than it was at the start of the year. Mortgage demand declined 6.2% during the week ending March 14th, according to data released Wednesday by the Mortgage Bankers Association. Housing Wire lead analyst Logan Mohtashami said earlier this month that the battle over interest rates is likely to heat up. Fed Jerome Powell was sought to distance himself and other policymakers from political pressure from the White House, and Treasury officials push for lower rates to spur economic activity. If the economy tumbles into a recession, the opinions of the White House or Federal Reserve will take a backseat. The real drivers will be falling bond yields and mortgage rates, Mohtashami wrote. However, just how much they drop is mainly in the in the hands of the Fed, which controls about 65 to 75% of the shifts in the 10-year yield and mortgage rates. And I want to jump back over because I think that's really telling, right? Is that there seems to be that push pull in some of this. And I mean, I look at this for mortgage rates and I go, okay, I'm glad we're under 7. I think that's a good thing. But again, I was listening to a few other people, and I would say the consensus really for a lot of people is that we're going to stay probably in the 6s. And if we get even below 6.5, it might be surprising.
We might. I mean, my hope obviously is we hit 6.
Mm-hmm.
That unemployment hits 4.4%. That will be key. But here's another big factor. The Fed likes to look at the PCE report, which is similar than the CPI inflation report. And if you look at the CPI report, it can be very misleading because, and Powell talked about this a little bit, is because we have all these lagging indicators.
Mm-hmm.
It's like right now, month to month, we're not seeing large, massive inflation numbers, but it's still a 12-month look back. And that shelter cost on the PCI report is 44%.
It's huge.
Of the report. And if you look at shelter costs with the Fed's data versus like apartment.com, Zillow.com, and all these other sites, they're not showing that shelter costs are increasing at a rapid rate. And if you actually were to take their numbers and then mix it in with the other inflation numbers, real inflation is not in the low 3s. It's really more like 2, which is core, which is what the Fed is going for. But then again, they don't look at that. They don't care about this other data. There's another great website called trueflation.com that you can look at. And that's also painting a very different picture about inflation. And they've used like 1,000 data points. And they're saying, core inflation is really around like 1.95, 2%, something like that. So some of these data points are just very outdated. And we've talked about this before with the shelter cost too baked in there is that owner's equivalent rent, where they just pull people and say, how much would you rent your house out for? And they say these monster numbers, of course, because who's going to say a low number? So there's things like that scare the Fed that are probably not real.
Right. Well, and that's the thing, right? Is that in that shelter cost number, like that's how they get that number half the time. just asking people, what would you take for your house? And it's like, well, if someone wants to pay me 20 grand a month for my house, great. I'll take it.
Right. I mean, motor vehicle insurance, we're taking a beating because of that as well. This last report, airline fares had dropped, which actually really helped us. But
I don't see that when I'm looking at airline tickets, by the way.
What's that?
I don't see that when I'm looking at airline tickets, by the way.
Oh yeah, exactly. And even Southwest is apparently about to start charging for bags.
Oh my gosh, there's a huge uproar about that. I digress when I start talking about this.
Is people, there's actually talk about that they'd advertised that they were never going to do that, and apparently there's going to be a class action lawsuit.
Oh wow, that'll be interesting to watch. But
another interesting report yesterday that Barry MBS Highway was talking about was FedEx had reduced their earnings by a decent amount. I don't remember. I apologize. I don't remember the amount. Was it like maybe 25% or something like that? But because that obviously is indicative of small business as well as large business, the fact that they're projecting a lot lower, that is a recessionary data point.
So here's that article about FedEx.
Okay, 12%. Sorry. That's
yeah.
being dramatic.
Shares of FedEx dropped 12%. As much as 12% Friday morning to a nearly 2-year low after the package delivery firm cut its annual forecast. The move raised worries about the health of the U.S. manufacturing amid uncertainty from the Trump administration sweeping tariffs on trading partners. I'm just going to stop because I was going to say this earlier. I really feel like April 12th is that tariff deadline, right? Or that drop dead date. And I really feel like until we're going to have a lot of pontification about what is happening, what's going to go on, all of this stuff. Right. But until that happens, I just don't know that we're going to know.
No, and that's the word you keep seeing in every single article is uncertainty.
Totally.
They don't know.
They don't know.
And President Trump could change his mind on any given day about some of these tariffs. And also, are these tariffs, as Powell mentioned, are they potentially just transitory, where it's just a one-time hit, where it's not going to really cause a huge impact on inflation in the long run? It may not. We don't know. And I was talking to a guy the other day that had run secondary departments for mortgage companies where their job is to just hedge. And, they come up with mortgage rates, obviously, to sell on the wholesale market. And none of these guys know. Right. They're all, as educated as they are, they're all kind of in the dark about what do we think is going to happen right now? How do we price our loans?
That's why I say I don't know that anything is going to be known until that April 12th date. I really don't.
Yeah. And I don't know.
There's a lot of people just kind of sitting on the fence, just waiting. And they're all, just trying to figure out what's happening. And that's why I feel like for me, the questions that I get a lot, again, are like, what's happening with mortgage rates? When are they going to change? What are we heading towards a recession? And then how is this all affecting the housing market? And it's interesting because here in Arizona, our housing market, it has shifted. And we've talked about this, on my channel a few times. Like, we are technically in a buyer's market as a whole in Phoenix.
As a whole, yes, we are.
Right. Certain cities are not reacting the same way. Different price points aren't reacting sometimes the same way. Right. But as a whole in Phoenix, we are in a buyer's market. So, and our inventory has increased, which is a good thing. But I can tell you, kind of as someone that has a lot of buyers that are out there looking right now, the reality of what is out there isn't always great. I mean, it's still hard to find houses that buyers really want to buy, that they want to get really excited about, because there are things that are, that the house still needs to be updated. The house, needs a new roof. The house needs a new air conditioning unit. Like, there's just a lot of, and the seller wants top dollar.
Right. And we were talking about this earlier about the Crawford report had talked about that the huge increases in inventory are below 600,000.
Oh yeah.
We haven't seen massive increases in inventory in the higher price points, right?
Well, and I feel like sometimes in those higher price points, because I watch, obviously I'm on MLS every single day, and I see, things, and I've got searches that are set up. And so I really pay attention to all this stuff. I see houses that are coming on the market, but I also know immediately when one comes on the market and I look at it and I look at the pictures, I'm like, that one's not lasting. That one is not lasting. The other ones, we were talking about this earlier. I have one up the street from me. Just came on the market. The house is original. It was built in the 98. It was built. Everything is original in the house. And the agent that took the pictures took them with his iPhone. I can see the owner walking in the grass because of the window. I can see his reflection in the window. This kind of stuff, it just doesn't work anymore for buyers. They're less likely to go see the house. Sellers aren't. I don't think sellers are as knowledgeable or kind of being told, great information sometimes about what our market really looks like. Sellers, if you're going to put your house on the market, it has to be spotless. And I don't mean just like clean spotless, but you have to make it look like a model home. It sucks selling your house. It just does. But it has to look like a model house.
It does. I can't imagine, selling real estate in like Boston or something like that, because if you think about Phoenix, again, like we said, a house built in the 90s, that's pretty normal.
Right.
I mean, we're a newer city in terms of a lot of our inventory.
Yeah.
So, and I was telling you earlier, I've seen multiple homes. Like I've had clients under contract that have walked over the repairs, the Benzer repairs, because sellers are not being properly educated by professional agents about, hey, you can't put this house on the market. It needs a new roof. Like they're gonna figure it out. They're gonna do an inspection. They're gonna see it needs a new roof. It needs a new air conditioner. Needs a new water heater. All these big expensive fixes. Or if you're in Central Phoenix, sometimes when they do the scope and they look at the sewer, things like that, plumbing. I had one that he was a very amateur flipper. I think he probably watched a few Netflix shows. And I mean, this house needed a minimum $6,000 worth of electrical work. It was the original panel on the home from like the 60s, right? It can be a really expensive fix. You can't just put some nice fixtures and nice things in and expect the home's going to sell. It has to be ready to sell.
Yeah, it does. And I mean, you can't, I call that lipstick on a pig.
Yeah. What was the one you're telling me about, the foundation?
Oh gosh. Earlier. Yeah. I have a client that was looking at a house and there were foundation cracks in it. And literally come to find out, a neighbor came out and kind of shared, oh, by the way, every single house in this neighborhood has had foundation issues.
Very interesting. So I just had one last month where there was like a 30-foot quarter-inch crack, but we got a structural engineer to go out.
Right.
He said, look, there's no problem with this. It's just cosmetic. It's a $6,000 fix. And in this case, one of them was going to be out of work for a little while over procedure. And they're like, well, we could put it off. We're okay. We don't have to spend the $6,000 more. The foundation is safe.
Right.
But they took the time to have a structural engineer go out and confirm, yes, this is okay. Because that's going to be an insanely expensive fix otherwise, right?
Well, and that's the thing, right? It's kind of, it's making sure that if there's a fix, what does that mean, right? And that's what I'm seeing right now when I'm out there with buyers, is that there's a lot of homes. There's homes on the market. It's great. There's more things for them to look at. But in all honesty, sometimes they're looking at it, and even just looking at the pictures, they're like, I don't want to do that much work, not at that price point. And that's
it's really
the thing.
Agreed. And it's really occurred to me, I'd say in the last 6 months more than my 21 years, is how I see high-level professional agents doing all these extra inspections and things that they're catching versus people that are half in the game. They're running the actual just minimal inspections, and people that is not their area of expertise, and they're just saying, yeah, I think it looks okay.
Right.
I mean, which is obviously a terrible idea.
Right. No, I mean, you've got to know. I mean, I started adding sewer scope inspections into my inspections probably 2 or 3 years ago for every house, just because it's important.
It is. And especially like you're in, older areas, you can't predict, you can do a scope, they have all this great technology that's, with like a video they can shoot underneath and look, but you can't predict what roots might do or something in the future. But you can go ahead and say, okay, it looks fine now. And just so you know, if we had to rip up your house and replace this, it would cost whatever, 30,000 or whatever, just so you know that this is something you probably will have to endure if you stay in this house for the next 20 years.
Right. Exactly. All right. I'm going to jump over here. Sorry. So back over to, is the recession driving down lower mortgage rates now? This is one, and this was written by Logan Motoshami. It probably has some of what you were talking about earlier. So there was an interview on Fox News, I guess, with Trump, and I didn't see it, but they were talking about tariffs and recession. But it says there's been a buzz on social media with many speculating that he could be steering us towards a recession due to his ambitious plans on tariffs and cut to government jobs and spending. I have my own recession indicators, which haven't flagged a labor trigger yet, but let's dive into this topic more. So as I've talked about the economic effects of Trump's policies a lot over the last few months, the vibe coming from the White House has been a push for lower mortgage rates. After all, Trump's policies have the potential to create quite a stir in the market. The situation feels reminiscent of Trump's first term when stock prices took a hit in 2018 and 2019. Back then, Trump frequently sent people out to reassure the media that everything was under control, even amid the chaos of the trade war. I have delved into this topic in several recent episodes of the Housing Wire Daily podcast, which is great, by the way, if anybody wants to listen to it. And honestly, what's unfolding right now seems pretty par for the course for Trump and his unique approach to leadership. We didn't see a recession in 2018 or 2019. And right now, the bond market, to me, isn't saying we're going into one. So let's look at the market. So this Monday. So this
what
article
day was this article from?
It was March 10th. So it was 2 weeks ago.
Okay.
Yeah. So it was, again, I try not to pull articles that are super, super far.
Yeah, no. So we've been in this range again, like the 10 years at 4.27. This is at 4.22. So yeah, we're still in the same.
Right. Okay. So it says this Monday morning, we observed the 10-year yield at 4.22%, pulling back from its year-to-date peak of 4.79% that we saw on January 14th. It's an intriguing time in the bond market. While some might expect signs of recession, I don't think we're there yet. Even since 2022, we've witnessed a pattern of growth scares followed by lower interest rates. This is that's that 10-year treasury. So the 10-year yield trades below 3.8%. It would indicate that the market is anticipating significant economic weakness in 2025. However, we are not at that point yet. Last year, the 10-year yield dropped as low as 3.63% as labor data began to weaken, leading many to believe the Federal Reserve was falling behind and needed to implement further rate cuts. Motoshami was one of those.
Yeah, and what's really interesting is think about that rates were still fairly high last year. And if we had 3.63 today, because the gap is lessening, I mean, we would have rates like in the mid fives, lower fives. Like, it would be pretty massive.
Yeah, I know it. It's crazy. Afterwards, we experienced a few months of stronger economic data, which resulted in rising bond yields. For the 10-year treasury, for the 10-year yield to go below 3.8% now, we would need to see much weaker labor economic data. Many people are interpreting President Trump's interview as saying he doesn't know whether we'll go into recession, which is why the market is acting like it is today. In short, while the bond market isn't signaling alarm bells yet, it's a space worth watching closely.
Yeah, and if you think about the immigration and the government cuts, I mean, that's going to impact unemployment for sure. There was a period where some of these rosy jobs reports we were getting, a lot of the jobs being added were government jobs, which those were obviously viewed as inflationary. It's not providing a boost to the economy. It's just costing the Americans more money, American taxpayers more money. And then for a long time, we were getting a lot of job gains in like tourism, hotel, services, entertainment. I don't think we're getting those boosts anymore because that took a long time because remember during the pandemic, all those people lost their jobs.
Right.
And for like the next 2 years, we're getting all these jobs that were just simply coming back.
Well, and that was a thing too. I mean, I talk about this a lot. when you look at what our job market looked like in 2007, 2008, right? We were low paying call center jobs, tourism and construction. So when our market took a hit because of, the market crash then, like us and Vegas, like we just got decimated, 50%
were
lost in
so
home
heavy on
value. Yeah. I mean,
construction.
it was awful.
Correct.
But since then, right, they've made this big shift in our employment base here. And so now it's a lot of financial, healthcare, manufacturing jobs, and there are a lot of high paying jobs. So it makes a big difference when we look at what our overall unemployment rate looks like.
Massive.
And Arizona's has been below the national average.
Correct. That's what I was going to say. Arizona's numbers have always been better. And the state of Arizona has a wonderful group that has been doing a bang up job the last 10 years in terms of bringing companies to the valley, like massive. I mean, to think they would have, like 10 years ago, to think you would even dealing with $1 billion+ investment here would have been crazy. Now they're dealing with multiple at a time. You have the semiconductor, you have all these huge companies, and they're high paying jobs. There are a lot of jobs that are requiring, not just degrees, but master's degrees that are all, 6-figure jobs. So that does bode well for Arizona.
There's also a lot of startups coming here too, which is also a great thing. A lot of tech startup stuff. But it's funny, I was at a meeting. When was the Super Bowl here last? Was it 2 years ago? 1 year? It wasn't this last year, but it was the year before, maybe
2 years ago, I think.
Yeah. And I went to a meeting before the Super Bowl came, and it was really interesting because they had somebody from the Super Bowl there, and he was from the Economic Council, somebody that really helps with all the Phoenix economic stuff.
I forget what it's called. Yes.
But it was really interesting when he was talking about their prep for the Super Bowl. And what they do is they go out and they woo these companies and they say, come to Phoenix for the Super Bowl. We want to show you what our town is really like. And they said the last time that they did this, I think they had 75 companies come, not 2 years ago, but the time before that we had the Super Bowl. They had 75 companies come, and 30 of them ended up coming here and bringing their companies after that. Something like that. It was pretty phenomenal.
I know that they have offices out of, I think someone was telling me they have a small office in Jerusalem or Israel or something.
Oh, really?
Where they have offices, little tiny offices in multiple places around the world, people that are just trying to bring businesses to Phoenix. So I think I could correct me, I might be wrong, but I believe Governor Ducey was a major proponent of growing that economic.
Yeah, I think you're right. I mean, because it was kind of when he was the governor, there was a lot of changes in the overall job market arena, so that we had a lot more. There was just a lot more opportunity for people.
Right? It's diverse. There's no question.
Yeah.
That in terms of just looking at Phoenix versus some other cities of the same size, economically, we should be in good shape for a very long time in terms of our employment numbers, which obviously at the end of the day helps housing, right? Helps knowing that, hey, if you buy a house, you live in it for 5 years, you should be just fine. And obviously
go ahead.
But obviously, you're talking about the overall market, the seller's market. But yes, if we look on the outskirts, right? If you look in Maricopa, some of those outlying areas, yes, we are seeing a lot softer market than closer into the city.
Well, and again, I mean, we've talked about this with Tina, is that the areas on the outskirts of town, those areas are a lot more new construction, right? So those are kind of get hit first. The interesting thing though about it is the new construction and the new home builders, they have something to offer that resale sellers also have to offer. However, some of these sellers that are reselling their home, they don't understand it, and their agent maybe doesn't understand it, and that's that 2-1 buy down. And I'm always cautious of that one. I mean, I think it's a great tool, but you have to know that. I mean, and there's people out there that are in this situation. We were just talking about this. They did that 2-1 buy down 2 years ago, and now they're in the situation that the rate didn't go down.
It is really unfortunate, Shawn. And I've definitely helped lots of home buyers with 2-1 buy downs, and I think we've all anticipated, because we're we're right at 3 years when rates
Right.
started to jump up. And, we're not far away, honestly, with another couple good weeks in the market. I think there will be streamline opportunities for people. Those FHA loans that were in the high sixes, we're not far off from doing the 5.75, 5.875, where it
Mm-hmm.
could be justified,
Mm-hmm.
uh, especially on these government refinances. But yeah, I mean, it is unfortunate. And yes, we do qualify people on the maxed out payment. But we're still, since they started tracking home affordability in 1990, we're still at like the least affordable that we've been as a country.
Yeah. Well, and that's the thing. It's like, as a country, it's not just here.
No,
And I know a lot of people used to come to Arizona because we were so affordable. And unfortunately, we're not as affordable as we were.
correct.
That's
Correct.
the reality. But the thing that I look at is that at the time that we were really affordable, we didn't have as many high paying jobs as we do now.
And like I said, we were not just dependent on a few industries.
Right. Right. I want to look at this other article here. And the reason that I think it's interesting is because it goes into what Powell said specifically in his speech after
Uncertainty. Yes.
that
He's
had to,
uncertain. That's uncertainty. Yeah.
right. But yeah, exactly. Uncertainty. Uncertainty was Powell's favorite word of yesterday. But this goes into down at the end of the article. It goes into, these are the housing related comments from Powell's initial statement. Powell didn't mention housing in his opening statement at the FOMC press conference. During the Q&A, housing related terms came up in two brief instances, more as a related detail than as a central topic in any question or response. Chair Powell's reference using housing service inflation as an example of improvement or distinguishing it from tariff-related inflation, which is more difficult to pin down. 2, Simon, I'm going to butcher his last name, so I'm just not going to say it, from The Economist, question listing some examples of growth risks before asking Chair Powell how confident he was in the Fed's positioning. So the housing-related comments from the Q&A segment of the FOMC press conference. Okay, so this was a question from Rachel Siegel from the Washington Post. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months? If there were specifics from the January meeting to now that helped you make these decisions? And this is what he said. So when we are separating the signal from the noise, that's just a way of saying that things are highly uncertain. Ta-da. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it is not really telling you anything. They're trying to extract a signal from that. And that signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Regarding tariff and non-tariff inflation, that's sort of a special case. The idea being that I do think that the first 2 months of this year are great examples. We've got high readings for good inflation after a string of readings at average close to zero. And you have to ask, it's coming during tariffs, but it's very hard to actually scientifically go back and match up those increases and say, yes, I can yes, I can prove that tariffs from tariffs, but it kind of has to be some extent. Plus, there's noise that can be idiosyncratic readings in various categories, of which will shortly reverse. And that happens to, oh my gosh, sorry, it's hard to read what somebody's saying. And that happens to, and that could be a big piece, could be a big piece of it. I think we'll know in a couple months whether those were where whether those were where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of the year and be able to say with confidence how much of that came from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else. And we'll be trying very hard to make that assessment. I'm sure we will make a lot of progress on that. And we already have, but it's going to be a challenge. So a follow-up question from her. Do you have any sense, do you have a sense yet as to what in your mind would make something cross from noise to signal? That would, sorry. Do you have a sense? It's very hard to read when somebody's just talking like that. Do you have a sense yet as to what in your mind would make something cross from noise to a signal? What that threshold would look like? It would depend on what we're talking about. I mean, obviously, we're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, it's something that was in the service sector that was far away from anything that's tariffed, like, frankly, housing service inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely moving down in a very good way. It's more now with goods and some extent with non-housing service inflation. So here's a question from Simon from The Economist. Several times today, you've said that you feel we're well positioned to wait for a greater clarity. At the same time, you could point to quite a few growth risks. At the moment, we've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, and the plunge of confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 and 19 see risks to downside. So my question is, how confident are you that you are well positioned, or that one more thing that you're uncertain about? Or is that one more thing that you're certain about? I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. Yeah. I mean, I don't know anyone who has a lot of confidence in their forecast. The point is, we're at a place where we can cut or we can hold what is clearly a restrictive stance of policy. And that's what I mean. I think that's well positioned. Forecasting is always very, very hard. And in this current situation, I think it's uncertainty that is remarkably high. I don't know about you, but I feel like I read a lot of...
I feel like he's certain that he's very uncertain.
He's certain that he's very uncertain.
And look, the Fed has always been reactionary.
Yeah.
They are never anticipating, right? It's like Wayne Gretzky says, you skate to where the puck is going to be.
Right.
The Fed has never, ever done that. So basically what will happen is, if prior to, the next Fed meeting, there could be a swift knee-jerk reaction to unemployment jacking up suddenly to 4.4, right? Or all of a sudden the shelter cost catches up, and all of a sudden we get like a 0% increase in inflation shelter cost. Then all of a sudden, boom, we're getting this awesome number for the month. And yeah, I think prepare for knee-jerk reactions.
Well, and I think that after the meeting just this last week, from everything that I saw, people said that they would expect probably 2 cuts this year.
Yes, that's what they've said. They expected to before the meeting, and they left the meeting at 2. And that's where the market was, the bond market was going, oh, are they going to say something like we only expect 1, or do we expect? I think that's what they were freaked out about. But no, that's still on the table. Again, it's like the meeting that follows it, it's always such a low percentage chance that they expect to cut rates, but they're still projecting later on in the year we're going to have those. And then there's a great website, CME Group, that you can actually go on, and they're always keeping kind of real-time odds of what they think the Fed's going to do with the Fed funds rate at the next meeting, and the one after that, and the one after that. So
yeah, I think that as it stands right now, the best that we can all be is uncertain, apparently.
Yeah, and I think in terms of real estate, if that was to happen and we were to see this precipitous drop, again, I tell all my young buyers, like, do not wait. Do not wait. If you can get a smoking deal right now, especially, I was just talking a couple before this call, they're looking in Buckeye, and they can get $20,000 off the house and get some concessions. I mean, that's a fair deal. And yes, we're going to do a 2-1 buy down, but they're okay with the full payment too. And it's better now because what if these rates do crash or they drop a point and all of a sudden, instead of being the only offer on a house, maybe there's two, maybe there's three.
Well, I mean, again, back to what we were talking about a little bit earlier, we are still seeing that sometimes in our market. We are still seeing multiple offers on a house. It is not every house. It is not all the time, but we are still seeing some multiple offers. And then back to your point about, is it okay to buy? I was just listening. I was telling you, I was just listening to somebody that has been a long time real estate investor, has been in the real estate business for a very, very long time, has made a lot of money in it. And it wasn't necessarily talking about investing, but somebody asked him the question. They said, is now a good time to buy? And he said, here's what I tell everybody. Now is a good time to buy if you can afford it. And the reason I say that is that, yes, home prices are higher. Yes, mortgage rates are higher, which is going to affect the overall amount of home that you can afford. And it's going to affect the overall, monthly payment. However, if you're going to stay in a house for 10 years, it is better for you to buy now. And then in 10 years, the home price is going to go up. He said, because historically, we have never had a 10-year stretch where your home price didn't appreciate ever.
That's correct.
So if you can buy now and you hold it for 10 years, you're always going to come out ahead. And within those 10 years, even if even if the mortgage rate's 7% and you can afford it, right? During that 10 years, at some point, the mortgage rate's going to come down to maybe it's only even 6.5%. But if it makes sense to refinance at that point, refinance, save some money on your overall month, mortgage payment. But in that 10 years, you're going to have an appreciated asset.
There was, I remember, I think it was from Keeping Current Matters. There was a chart, or maybe it was Barry Habib, where he talked about, you go back to like 1950 or something. And if you bought, again, not city specific, but just in general, you could literally buy a house any year in the last 75. And if you kept that house for 10 years, there was only like 1 year where if you bought and you were at like 0% or like minus 1%. But keep in mind, you're also paying an amortized loan. Right. You're also paying down a balance by just living. So that is, even without actual appreciation, you're still increasing your equity position, right? So I thought that was really interesting. Like you could, any 10-year period going back to 19, you're still going to make money. So I think what he says is absolutely spot on.
Well, yeah, that's what he was saying too. I mean, it's just, if you're going to look at it for any length of time, any 10-year period, you're going to be okay. But he also said, if you're looking to buy a house right now and you think you're only going to be there for 3 years, like don't buy, just rent.
I think it would have to be, you would have to be supremely confident in the deal you're getting and the area in order to justify and know that maybe it's also, and if you can't do that, that it's going to be in a solid rental market where worst case scenario is you could take advantage of all the tax loopholes, et cetera.
Right. And I've had two people recently that they were going to sell their house and it didn't sell because it would just, what they paid for it and what, all the numbers and everything just didn't add up. So they turned them into rentals, and they're like, we're just going to rent it for a few years and just see where we land, what's happening with the market. And then we'll, look at selling it again.
Yeah. Which is the great thing about real estate. It's elastic, right? You can choose different things.
Right. I mean, he rented it for a year and then called me and he said, should I sell it? And I said, no, if your tenant is willing to stay, keep her. Keep your tenant for another year at least. And then we'll talk about it again in a year. And he was like, okay, she wants to stay, but I wanted to talk to you first. And I said, no, keep her as a renter. Cause I knew what he paid for it. I'm like, we're not ready yet. It's not time.
How nice is that he knows he can call a real estate agent and they actually say, now is not the time to sell.
Now is not the time to sell. No.
Well, being honest and giving good professional advice, Shawn, which not everyone does that, right?
I know. I can't help myself. I can't.
Obviously, that's what comes around. That's why you get so many referrals, is because you're giving people the right advice.
I try. I mean, and if I don't know the answer, I will do my best to get it because I can't have all the answers, but I've been doing this for a while enough to either have an answer or know where to get it.
Hey, if Jerome Powell's not certain, we don't have to be certain either.
Right. I know.
We can be uncertain.
Let's all be uncertain together. I think we are. I mean, ultimately, right now, I think that everybody is I just feel like everyone's on edge. They're watching the stock market. I've got some clients that are saying that to me. I'm like, oh my gosh, I just don't know what's going to happen with my stock. This is what happened when I was younger. And I remember when the stock market, or when the 2008 happened, right? And we had money in the stock market. And I remember calling my financial planner and I said, should we take our money out? And they said, you have not lost a thing until you take it out. If you need it, then we can get to it. But if you do not need it, you need to let it sit.
Good advice.
And so I did. But again, you don't learn some of this stuff until you get a little older. And, but then even when you get a little older, things happen and you're like, oh God, this is my retirement. And is it going to get wiped out? And I still think people have some PTSD, honestly, from what happened in 2008. So, I mean, and it's fair. It's fair to feel that way.
I agree.
So, I mean, I feel you, but I think that right now, real estate as a whole in Arizona is good and bad. I don't know that there's another way to say it, because in some areas it's good and in some areas it's bad, as far as both for buyers and sellers.
Yeah, if you're somebody that's trying to sell a home on the outskirts right now, it may not be the time to sell, depending on
when you bought.
Yeah.
And even in Scottsdale, I'm seeing houses in Scottsdale that are sitting on the market. Prices have to be lowered. And it's taking longer for them to sell.
I was talking to an agent the other day, and that these people had bought a really small home in Maricopa. And she's like, well, there's debating if they want to sell it. I'm like, okay, so how much do they pay for it? Like, oh no, they paid $140,000 for it in 2003. I'm like, and now they're upset about selling it for $320,000. And you're like, you really can't get upset about selling it for $320,000. Yeah, I know they wanted it sell it for $350,000, but they've still done incredibly well.
Right. And that's what I mean by sellers are having a hard time right now, because they're remembering what it was like during the pandemic. And that time gap, they forget how far away that was, and that the market has shifted. And because they're not in the market every day, they don't know how much it shifted and what has happened. And so you go to talk to a seller and they're like, okay, so how many offers do you think I'm going to get in the first weekend? And I'm like, we're not in that market anymore. Now, granted, I mean, there's some houses I go and I look at and I'm like, yeah, we could get a couple offers the first weekend. We could, and they're like, well, only a couple. And I'm like, our market is different. It is, there are buyers out there and we will get a lot of activity and we'll get, it'll be fine. But it is not, we're not getting 20 offers and you're not going to get $200,000 over your list price. That's not going to happen.
Yeah.
So yeah, it's interesting for sure. Well, I know you're in Vegas and you're watching basketball. Who are you rooting for right now?
Squad right here, Auburn.
So Auburn. Okay.
Play again tomorrow. So yeah, just enjoying and maybe have a good meal or two.
Right. No, yeah, you can find some good restaurants there in Vegas.
Few. Yeah, just a few.
I went to Gordon Ramsay's restaurant there a while ago. It was good.
Oh my gosh, Gordon Ramsay's place is legit.
Yeah, it was so good.
We're at Cosmo, and we're going to go to Ari, I think, tomorrow. They've got a really great Asian fusion restaurant. They've got a great Mexican restaurant. So yeah, lots of choices.
Right. It's not windy there, I hope.
I haven't been outside.
Which is normal. You're in Vegas. Even when you're inside, it feels like you're outside.
I haven't left where I'm staying. So yeah.
They're just
not too worried about it.
Yeah, they're pumping the casino floor and everything with oxygen to make you not realize
it smells really nice. And yeah, exactly.
Well, have fun. Thanks for joining me, Matt.
Thanks for having me on.
Everyone for joining, and we'll be back next week. See ya.